And my first business got sold in 2003, 4, and we sold it for book value. So, never raised any money. And now I can say how I learned to invest was the experience I had setting up and running London Co-Investment Fund. My biggest angel exit was a company called OpenVC. It got built last year by Olympus.
Today, we're joined by John Spindler. John was a successful founder before transitioning into being a successful angel investor. One of his investments is up over 60 times his initial money. Following his angel successes, John has overseen the London Co-Investment Fund, which has invested over £85 million into 150 companies. His seed fund was one of the first in the UK to focus exclusively on AI applications. Now John is the founding partner of Twin Path Ventures, a pre-seed AI-focused fund based here in London. 30 portfolio companies today. It's a great episode, so let's get stuck in.
But just before we do, let me introduce this week's sponsor of the OpenVC podcast, Intercom.com. Intercom help founders by making your customer service 24/7. Through their use of innovative AI, you can answer 50% of your customer needs instantly. Intercom is offering 1 year free if you use the code OpenVC, all in caps, at the checkout using the link in the description below. And let's get back to the episode. Thank you for joining us on the first season of the OpenVC podcast. It's amazing to have you on the show.
Thank you, Harrison.
You're extremely accomplished as an angel investor, as a VC, and also as a founder. So I'd like to take you all the way back to your earliest entrepreneurial experience. How soon did you get started? What was your first entrepreneurial venture?
Well, I didn't, to be honest. I mean, it's an interesting thought for my generation, getting brought up in the 80s and 90s. What do we think a founder was? And I think it's to some extent not changed that much in the mass population. I was brought up in Yorkshire. As a founder was a person that built a lifestyle business, basically a trader effectively, buying low, selling high, if there's any differentiation on the service. And it was almost, and the type of entrepreneur was a person that bought low, sold high. And that actually didn't really appeal to me. My mother did that. She ran shops and things. And so I didn't come in. The thing that kind of sparked my kind of entrepreneur journey was actually the dot-com boom. Because what the dot-com boom got me to think about is you could be an entrepreneur and also to be creative and create something that was impactful. And I think still that doesn't come across a lot for tech founders. Basically, people are trying to ride a new wave based on a new technological breakthrough, are very different from your standard entrepreneur that are looking to optimize the present system. And
interesting.
I think it doesn't come across enough in media or in basically, especially mass media. You still have this with popular programs like Apprentice and others. An entrepreneur is, someone who basically, kind of buys lemonade for $1 and sells it for $4.
You can get a lot more exciting than that, especially in the digital space.
Yeah, and so that was my kind of opening, and then I suppose I was in my mid to late 20s when the dot-com boom started, and I got involved in it towards what at the time I thought was the peak, end of 98, 99. And obviously it all blew up in kind of the first quarter of 2020. But at that time it looked like, Web 1.0, kind of with the development of basically websites, basically we've just been talking about things like Chrome and browser technologies, etc. It all seemed to be kind of possible. And my first business was really a software business. It wasn't that exciting. I tried to get into the more exciting. We were pitching like hell, but we ended up doing SQL databases, building them for order, and we did reasonably well. And then that business got sold in 2003, 4. After the dot-com boom, I just wanted to go off and do other things, including myself, and we sold it for book value. So, never raised any money, sold it for book value, but it was okay actually, traditional, kind of etc. I did a consultancy business, which was actually quite successful and made a decent amount of money. Sometimes I call that venture building because we did not do venture building as we described at the time, but that's what we were effectively now looking back doing. We're getting paid to put together and set up businesses by corporates and sometimes governments, etc. And then I got bored of that, got frustrated. And I think you do if you're going to be building something for someone else. And I did know software and I did know the web. And stupidly, I met a friend who was building a hardware business. And I went full in and invested life savings at the time that I'd made from previous exits, etc., into a hardware business, assuming that they had similar trajectories from media and basically kind of software. Obviously, it doesn't.
What was the product?
The company was called Ferguson Hill. We were building audio equipment. Initially, this was a day of audio equipment where you just had basically the emergence of iPhone just come on. Basically, we were building across the board, and we did okay. The product was never perfect. We had many different iterations of it. We sold through the likes of Apple, but the 2008 crash, as well as some massive mistakes we made, kind of really killed the business as a really going concern by around 2011-12. And I suppose that's when my story getting into tech and what we mean by tech now started. One of the things I never came across when I was in the 90s and noughties was the techniques and methodologies that were developed after the dot-com crash that basically meant that starting a business was a very different proposition to what it was seen to be before. So you had the developments of people like Steve Blank and Eric Ries and the emergence of accelerators, etc., taught those techniques like customer discovery and all of back in the 90s and early noughties, we would write enormous 120-page business plans saying everything would just be like that. And often your first person you recruited would be your CFO. Kind of like to, etc.
Different age.
And different age. And obviously Steve Blank's book, 4 Steps to Epiphany, showed that a startup is actually not a scaled-down corporate, with etc. It's a very different beast. And those methodologies came across. And actually, I do remember a friend of mine called Sal Varani, basically, who had been working in Silicon Valley and came to London in 2009-10, invited me to an event in a part of London called Camden on a Saturday morning where there was Eric Ries talking about lean startup. And I remember, this is my third business by then, kind of like, I'd never heard of it. And stuff like, had you really done any customer, had you really spoken to your customers and worked out what they wanted? And particularly in hardware businesses where they're engineering led, even today I see other hardware businesses don't do enough customer discovery. And the problem with hardware is interesting because people are saying now, why doesn't investors invest in hard tech like hardware? Obviously the margins are very different. You have to have stock, you have to have a lot of upfront tooling. But the big problem with hardware compared to software, social platforms, etc., is the time it takes you to learn and the cost of learning. So when you iterate and produce a product in hardware, just like in software or in social or whatever, it's probably likely to be wrong. You probably want to iterate and adapt it and develop it. Yeah, but in hardware, that's incredibly hard because you've committed a production run of thousands and thousands of a product coming down production runs, sitting in warehouses, which isn't great. It's probably over-engineered, probably overpriced, and you can't sell it. And that was some of the problem we had, etc. on that. And that's really hard. And obviously, this is also an interesting time because what happened in the noughties was China entered the world market. And China initially entered the world market as contract manufacturers. Mm-hmm. So you can see it's just today with Foxconn still doing that for people like Apple, is that you got the Chinese turn up and say, the cost of putting together a factory production run in Europe, enormous amounts of money. And there wasn't much VC money around at those times. But if you partner with us, our government will cover that cost. And you'd only have to pay a fraction of the cost to do it, some of the tooling. And also they would fund things such as your cash flow.
Yeah.
So they would fund the production run. So you wouldn't have to pay for the production run until you actually sold. Yeah. And therefore that changed and that means drove down the prices of hardware considerably, massively, because previously you would have to basically sell a hardware product, make enough margin so you could build the next one.
Yeah.
But now the Chinese were funding everything up front. You could drop your prices, and if you made a 10 or 20% margin, it was really profit to fund growth.
It goes against conventional angel investing wisdom of today, where people are told to run away from hardware startups because it's so risky. And actually, being a contrarian investor, maybe there are opportunities in that space.
I think it is, and it's still there's still people do early stage companies still do contract manufacturing. So where you rely on someone else with all the manufacturing facilities, expertise, logistics, and cash flow to cover your initial costs. The Chinese, as far as I understand it, have stopped doing the "we'll fund your cash flow," which has I think they don't think they need to do it as much. But yes, it still has that kind of issue. And people don't realise as well, when you're selling through platforms or into retail shops, is they take such large margins, the sales distribution, and you actually don't get paid until you've sold. So you spend all the money of the production, marketing, etc., to get it into, say, well-known shop or well-known online platform, and they will pay you 60 days after the first item has been sold. And so it's very difficult, the cash flow, the amount of money required. And people say, well, why don't small VC funds fund hardware? It's difficult because we don't have enough money. If we were, roughly $1 million investment in a software company, you probably need around 5 to 10 times that for a hardware.
And there's probably less upside as well.
It could be less upside.
So there's a lot of reasons to not go into that space. And actually, after all these lessons that you've learned in the hardware space, you became an investor. You started as an angel investor, had a very successful initial investment out of one of the first 8 investments that you made that was up 60 times on your original investment.
Yeah, I mean, that was completely accident, to be honest. I went into angel investing because I had some cash. And because I was working at Capital Enterprise, I was CEO, and we were supporting accelerators. And I was seeing all these interesting startups coming about in 2011, 2012. And yes, most of my peers were saying, why don't you put your spare cash in a buy-to-let property like everyone else is doing? And I said, no, I'll go and do. And I, quite frankly, didn't know what I was doing. And actually, my first, 8 investments, if you came back to me 2 years later, I think virtually all of them were dead or underwater. But one of them persisted, and it looked like it was going nowhere for about 5-6 years. I forgot about it. And then the founder got back in touch and basically said, all this time I've been doing X and Y, we've reinvented it, the market has changed, blah, blah, blah. And now I can say, yes, it's success, which shows you. But I think how I learned to invest was the experience I had setting up and running London Co-Investment Fund. And that gave me a much more deeper knowledge of how to make investments at the pre-seed and seed level.
So for those that don't know, the London Co-Investment Fund, it deployed around £23 million, but then there are other co-investors that came in, and I think they deployed 80 or so. So the collective group made over £100 million worth of investments.
Yeah, I think it was actually about 121 million, I think, but it's roughly in that figure overall. And then obviously we did some follow-ons as well, so it's probably another 5 or 10 million on top of that.
It must have been one of the first government-funded VC programs in the UK. So why was the London Mayor incentivized to create the London Co-Investment Fund?
It had a pot of money that wasn't theirs. It was it was given to by the then British government. So it was given to all the regions, and not just the London Mayor, others as well. And it was there to stimulate private sector investment. Mm-hmm. And interesting now because we have a new government that's saying it's all about stimulating private sector investment. And at the time, there was a big shortage of capital in the scene. And the idea that we came up with is people were finding it possible to raise £100,000-200,000. Equivalent now would be something like £500,000 to 3/4, but they couldn't get much further, and it was difficult. And so we came up with a program where we would top that up for every, And what the genius of the scheme ended up becoming, because we ended up realizing very quickly that the best thing, and I'll say this to others that run these co-investment funds that are popular around the world now, is source your own deal flow. Because I think that's so important. All the best deals we did was sourcing our own deal flow and not relying on our co-investment partners. Because there's a general tendency, not always, and it's not kind of thing, but if the deal is really, really strong and you have the available money, and there's more money available now, you want to take all that round. It's only when the deal is maybe a little bit that you would then go to others. Now, that's not always the case, and I think
You think it's a negative signal if multiple investors go into the round? because
No,
there isn't enough conviction for one fund to take the whole round?
I think in many ways it's the only way you can do it because there's not enough funds to take the kind of thing, especially the bigger funds don't come in early. So I think if you do them now, you're probably very much strict to pre-seed. We did seed, for instance, rounds up to 2 mil, and 2 mil then was going to about 4 or 5 now. But I think what I'm actually kind of saying is that if you source your own deal flow, the co-investment gets into the good deals. And we set up a whole operation to see around 5,000 startups across London. And then we would take them to our co-investment partners and they would basically look at them and say, yeah, I will basically complete the due diligence, do that deal. And we were already in.
Wow.
And
So how are you finding these 5,000? How are you finding that deal flow?
Well, we were very lucky because we had a whole strategy. I was running Capital Enterprise at the time. So Capital Enterprise in 2013 had managed to find a way of taking unspent EU money that was allocated to UK regions and using it to fund and set up and fund accelerators. So we were the first funders of Techstars in London, first funders of C-Camp, of Entrepreneur First, etc. And we kind of hacked a kind of funding that was supposed to be like X. We said, well, we could do it like Y. And that basically meant that the London scene in 2012, 13, 14, 15 was very much accelerator-led. Yeah. And it was partly accelerator-led because it was sucking in talent from all over Europe in particular, as well as the country. And accelerator is a great way of basically taking founders from one area and embedding them in an ecosystem. So C-Camp had already been doing that, but we able to, over 5 years, give them sufficient money that they could go from a very small team to quite an extensive team and basically do much more basically investments and make their business model work. And Entrepreneur First, again, we helped them for 2-3 years. We set up new accelerators like Space Camp, which basically still going kind of. And so that gave us all this deal flow. And we also had lots of people coming in because we ran, on the back of that, we ran a program of investment readiness. So for people that didn't get into accelerators, who were still kind of coming into the system, but didn't want to wait 3-6 months because they were mainly episodic, So that gave us lots and lots of deal flow. And we saw lots of great companies and invested in some of them, and unfortunately didn't invest in all of them. One that we to this day and very apt, but we decided we didn't do, which we should have done. And there was, Queen Cup and Lip was a company at the time called Revolut. But we kind of, us and our co-investors, I won't mention the co-investor, kind of somehow managed to not get in from mistakes. Actually, we actually wanted, it was a whole mess. But anyway, kind of like,
you can't lead your anti-portfolio. Give us some of the winners.
Well, we did companies that have done pretty well. We've had about 13, 14 exits on that. And companies that are doing well for us today, and people like Curve and Cognitism and Ably and Wealth, Kernel, and we also rode a lot of the kind of fintech wave of that period, and others as well.
It was the PayPal mafia effect, wasn't it? Silicon Valley had the big PayPal exit, and then the early team there went and created loads of other companies. London, being such a financial hub, had a lot of financial experts, and the earliest success of the startup scene was the fintechs. Those are the ones that we're now seeing that have done incredibly well.
Yeah. I think so. I think it was partly the talent that was here, partly the money as well. People, money in London to this day, to Britain, is still kind of, disposable surplus money, especially at the angel level, is still in the financial services, and people tend to invest in what they understand. And what they can see. And I had to say that the regulation was very good. It was open, it was keen, there was people in government pushing for new entrants. The Financial Conduct Authority was much more kind of encouraging than they are now of new entrants. And I think we built a whole kind of a platform of good companies that today are worth quite a bit of money. And we also attracted a lot of Europeans to come here. So yes, London Co-Investment Fund, we were doing 30 to 40 investments a year, and we followed quite a lot of the trends. Fintech, we did a lot of B2C platforms, marketplaces, which I must admit hasn't worked out as well. We did some e-commerce as subscription, which was popular at some of those stages. So we did quite it was quite broad, and we did. And actually, one of the reasons I ended up doing AI Seed is that we had these AI companies coming out of our accelerators and our universities, and they didn't fit at the stage the popularity for things that could get into revenue very quickly and that were not technically that difficult. And so we found that these companies were finding it very difficult to kind of raise money. I think we had only really like 10 partners, maybe 1-2 partners that would touch AI. But there was Nathan Bennett at Playfair. He was
But
at
because
Playfair
of
down in
investor
Scotland.
appetite.
Yeah, it wasn't very hot. Yeah, want to do AI. It's hard. What they want to do is AI when it stopped being when there was no technical risk.
Okay.
When you could apply SaaS metrics to it and say,
I suppose it is a bit alien, right? The first wave, seeing that trend before, it's never obvious until it's a bit too late, and the wave is popular and everyone knows about it. So.
That was definitely
that trend.
That was definitely
with AI Seed.
That was definitely the case. There was not as much appetite for AI. And a lot of AI companies, and you get this almost to, you've got companies that were AI, anything like it, would call themselves AI because they thought it was trendy. And they therefore basically kind of made, you'll see their pictures and their decks, and the last thing they want to talk about was actually their tech stack, because they didn't have much, and I remember we solved things like...
I love the story of when you went to a pitch event, but you were the VCs, and people being asked, what's the USP of your fund? And you get up and you speak and you say, actually, we have a technical due diligence expertise. We know about technology and we can help founders. And then at the end, when founders could come and approach funds and ask future questions, no one came to your stand because they were a bit intimidated, but you could actually uncover the fact that they had nothing under the hood.
Yeah, and that was kind of okay. And there was a kind of element which looked, and there still is, AI, let's get it to market, let's get kind of traction, and we'll find the AI later. Yeah. So people would tell us, oh, not AI today, but yeah, we'll probably put some AI in the future. And some of that can work. It's not there is different ways to skin cats, but we thought that particularly from technical, I did a deal called Bloomsbury AI with Seedcamp. And it was a difficult deal to get across, and we went round and round at kind of things, and we ended up basically investing, and that actually got bought by Meta. And that was one of the kind of cases that shows you how difficult it was, great team, blah, 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 to get anyone interested. And so that's why me and Tom Stone, and basically at the time, decided what we wanted to do, set up a thing called AI. So Tom had just sold his company, founding partner, got his PhD from UCL, in a company called Prediction.io that was bought by Salesforce. He'd moved back to the UK. And so we put together AIC, and we ended up doing 46 investments over 3 years. Our original partner has also now taken AIC on, and is going to basically restarted AI Seed. And so investors may start to see investing again, but not with me, not with Tom, but with basically a new team. And I think a slightly different focus, but I'm not quite sure yet because we're not involved. But, at that time, and we invested in, as I say, 46 companies. We were writing checks about 100 to 200K, and we did very well. That fund's had 5 exits now, returned all its capital to all its investors, and it's got some nice kind of companies at Series A, Series B. Doing very, very well. Overall, I think we'll return, stonking return to all our investors in the next 3 to 4 or 5 years. So that was it. And I was, when I stopped investing in that, and we stopped, in 2020, just before COVID, the next 2.5 years, I then went back to angel investing. So I did quite a lot of angel. I did about a dozen, maybe 13, 14 angel investments, kind of writing roughly 20K checks into kind of companies, some of them doing very, very well.
What kind of, so these 20 angel investments that you made after AI Seed, what kind of things were you doing differently to when you started? What are some of the lessons, what are some of the disciplines that you now impose upon yourself that you think are good principles that other angel investors can learn from?
I think one of the keys in understanding is that if you're going at pre-seed and seed, you're investing in signals, not data.
Okay.
And that's the big distinction. And I've done some work in later stage funds as well, Series A, Series B funds, and that's very much where you can build You can invest on data, and you can build your own models. You can build your own financial model, market model, etc., because you have the data not just on the company, but the market's a little bit more tricky. You've got data on competitors, etc., etc. So you can basically start to do some modeling to predict whether my investing at this valuation will be worth X later. You're not able to do that at the kind of angel. So you've got to kind of understand that a lot of it basically is around signals and what signals you can gain kind of are important. We still do to know that there is a systematic way to assess still basically is useful, but to know that you don't have the data to kind of fully put that model there. So I think there's still the classic 6 risks apply pre-seed and seed, and some of them even more so when they do at Series B, Series C, when you can use your things you get taught in MBAs, etc., how to do valuations, pricing, predictions, etc. So I think it's still the most important one is the team and what we call the execution risk. Do we think this team can meet the challenge? And if it's a technical challenge, which majority of AI is, then they must be able to basically have within their team the credibility, the experience, the know-how to be able to build AI products, AI systems. And then you've got obviously the market risk. Are there customers? Is there a market? Is there a problem that people care about? Blah, blah, blah. You've got obviously the third risk, which is often quite important especially in companies like AI or anything deep tech, is the technical risk. Can they build it? Tech product risk. And can they make it work? And can they and this is really important. A lot of people dismiss it, oh yes, it will when it works, it will generate this value. But when it works, how it's going to work is the reason why there isn't thousands of them already doing it.
I'd love to dive into that because I feel like, I think I read somewhere that founders applying to TwinPath, they are asked to submit a 55 part questionnaire.
It's actually
about technical risk.
It's gone up to 58 questions, actually. I keep adding questions.
What kind of things are you trying to extract? You don't have to give us all 58, but what are some of the bigger ones that you're trying to uncover?
It's based on the 5 Ps, which I originally got from a guy called Matt Turk, who's a well-known investor in New York, although we define the Ps a little bit different. So the 5 Ps are people. So obviously you're looking at experience, credentials, not just the team now, but who do they need to hire? And also their advisors and et cetera, the gaps, and do they understand it, and blah, blah, blah. And obviously this is holistic, every sector. You're looking at the purpose, which is a strong, why is AI required? Why does it add value? Why does it allow you to do something that others can't do? Where does it kind of give that massive uplift in value to your clients? And is it really worth it? AI is expensive, is difficult, probably won't work. You better have a strong kind of purpose. The bulk of it is around what we call the product, which is we look for them to give us data, a diagram actually, and full of data on the product, from data ingestion to data outcome. We want to know how they extract and transform and load data across that architecture, what models they're using, what evaluation frameworks they're using, how they assess performance today, and what's it need to do to get to be best in class in the future. Everything in AI is always a trade-off. That's the truth. And therefore, we're looking at what their view is, the trade-off, given the purpose of what the client thinks they need to do. And then we look at the fourth P is slightly embarrassing. It stands for petabytes because we couldn't find another. That's what Matt Turk uses it for. But I couldn't find another P. So it's actually data. Okay. So what is the data? Do they have enough data? What's their data strategy? Defensibility moat within the data? Do they have a data kind of flywheel? And, is that where the IP fundamentally is? And then we look at positioning, the final P is position, which is what most investors, professional investors are looking at, which is, who's the ideal client? How many clients do you originally have? What's your go-to-market? What's your, basic business model? Who you're competing head-to-head with anyone? Basically, what are the critical success factors and why you win? And we put all those in. We only give that kind of questionnaire out once we've had an initial meeting. Because we say, it's a lot of work. Do you want to do it? Is it worth it? Are we a fit? We're keen to kind of know that the innovation and the novelty and the long-term defensibility is in your app development and application of AI. If it isn't, brilliant. Go and do it. You don't need us go off and kind of like it's a business model innovation or it's just a go-to-market, et cetera, et cetera. And we have a lot of people. We've had a lot of teams, some very successful ones who've gone on to raise quite a bit of money. Obviously, I don't know they'll be successful in the longer term, who would just say to us, well, we don't really have a kind of, for instance, a North Star performance. We don't judge the engineering. It's just, does the client like it?
Yeah.
If the client likes it, they can have this, they can have that, they can have this. It doesn't matter. And we say, well,
it's quite telling. It's quite telling for if you extrapolate that sort of attitude, that approach into the next 10 years, that's probably not going to turn into an outlier.
It's hard. My view is obviously, well, I won't name the one, but that's probably raised more finance in the last 2 years from well-known VCs. And still today, because he lives near me, I can sometimes bump into him. He still kind of like smiles at me and says, still kind of, we can, we'll kind of turn around whatever the client wants. So sometimes, so it's not different ways to kind of do it. There's never a set way. This is where the innovation comes and actually, to do these. And people are always looking for formulas, and I don't think they're necessarily there. And coming back to what should angels look at? Signals. Important. And actually, one of the things that I think we need to understand a little bit, business model, how do they make the money? Do they make enough money to basically to get to a stage where they're going to generate this discounted cash flow that can fund their own growth without always diluting to investors? And this can be very important to angels who are fearful of always getting kind of diluted, or especially with liquidity preferences, getting kind of taken out of a deal, even if it exits. And also finance risk, very big one, which is kind of, do they have enough money to get to the milestones? And if they don't, who's going to helicopter money to them when they haven't hit those milestones? Who's going to give them water when they're going across the kind of valley of death, the desert, to keep them alive for another 6 months, a year, etc.? And there is always a problem with that bridge round to come to kind of see, is it just a recognition of failure? Or is it recognition they were undercapitalized and they were just hopeful that their investors would find some money for them sometime down the future? And it's very important for angels. That's what I learned from angels. You just can't be the person to keep going back to, and you can get to quite good money going after bad, etc., etc. And obviously the difference between VCs and angels is VCs have to make money. They have to have big exits, and they have to have businesses working in big markets to get those big exits. So if your market is really niche, they can't see the big exits to fund their kind of business models.
In terms, so Path now, it's AI focused, and I would say when I'm looking at deal flow, I'm probably most confused about the positioning side of things when it comes to AI products now, with the big releases of LLM tools and it being open sourced, and then there being OpenAI and so many others. How do you come to evaluate the market at the moment, and how do you think it's going to move? And
it is moving very quick. And one of the aspects of large language models, especially the large context windows they can do, and the emergence of incredible performance on zero shot kind of prompts, etc., is that sometimes the old verities do get challenged. Like, how important is data if all the data is contained in the large language models and the context windows are so large? Do you need specialized data to get the same performance? So the small language model compared to the big language model, it's difficult in many cases to see whether a small language model can compete, apart from in some very specific niches. So what do we...
One good one I've seen has been like a breast cancer screening product. They've got access to a unique data source of breast cancer screens from an NHS trust, and they've been able to refine their model on that very specific data, which an open sourced LLM doesn't have access to.
At the moment.
Permissions.
At the moment, that's the issue. Kind of like, at the moment, if they're, they're kind of soaking up all kind of data sources they can fit. But you're quite right. If you're building a supervised model, trying to detect, say, a known disease with a known biomarker, then basically the old kind of thing about the quality of that data, the ability of that data to be correctly annotated, labeled, etc., the models themselves aren't really the kind of that difficult. You're obviously changing the weights and nodes all the time to kind of basically to improve the specificity or sensitivity or whichever is more important in that detection or that classification. But you're quite right. In those cases, if the data is unique and out, and basically, and I think the problem with that data is that it has to be very correctly annotated and labelled. But people are, even in those cases, they're bringing LLMs in to basically so it's not kind of one or other. And I think we're looking at, with classic applied areas, you're looking at what else needs to be done. I mean, in classic applied, say in medical imaging, the accuracy has to be so high. The regulator is so difficult that you're probably still going down that old pathway. And that's, they're probably not as effective. LLMs will be a part of a tool to help speed that up a bit, but they won't replace kind of on that. And you can see the regulators in particular often are the barrier, because they want higher proof points and higher transparency, and
which is sensible and good for society.
I mean, obviously, I think sometimes it may be too much, but yes, generally overall.
Okay. So, what excites you at TwinPath? You must have made some recent investments. What's standing out? What do you think is defensible? Yeah. Could you tell us maybe a recent investment that's been publicly disclosed?
I'll tell you a little bit. We invest in 3 categories. Of AI, we invest in frontier. So this is when you're still challenging what can be done, and you're using the latest research, preferably your own, to be able to kind of push that further and further back and have a product that can do something that no one else can do at present. Okay. And one area of that is agentic AI, especially what we call long horizon agentic, where you're training things to do tasks over a long period, where the reinforcement correction, right or wrong, is 3 or 4, 5, 10, 20 steps in advance. Oh. And that means you as a human are able to keep on doing that. Kind of these bots often struggle to go beyond 1, 2, 3, 4 verifications. But there's been great developments there. And you're looking at teams coming out of leading universities. We backed a company, for instance, called WeCo out of UCL. And they're building a long horizon agent model to do data science coding. And to get that to kind of work, they have to produce so many innovations to get that kind of. I've backed a company called CoSci, basically, that has managed to get to which is 2 times better than Devin in the last 9 months. So, but they're still only at roughly about 30% equivalent of what a human software developer can do. The 30% they do is better than any human, but there's over 70% of the tasks who still and we've got one that's in stealth at the moment we think is a lot better than that, or could be a lot better than that. Looks like in what we've seen it will be when it's launched in September. And that again, so the agentic side is still really hard. It's really hard once you go beyond simple systems. And to do
the
more
exit
open
opportunity, is that going to be a trade sale, or are they going to own that space? How do you feel about that from the financial exit?
Yeah, the exits for those either way. They can either be bought by big tech, or they're going to basically go big themselves.
I remember I had an advisor who sold to Google, and he said, I think he had about 120 engineers for him. And Google's metric of acquiring the company was, and we'll give you $1 million for every engineer that you bring.
I think when companies buy you for the tech, not the cash flow, they're looking to buy capability. And so there has to be a capability threshold. So you're just like 2 people in a kind of kitchen. There's a capability for you to then to become that agentic AI, basically kind of unit for whatever is probably more limited. That's why. But it's not as actually, because I've sold to quite a lot of companies, big tech companies. It's not that it is important, but it's not everything on that. So we like agentic, we like it frontier. We've seen a lot. We're investing a lot in picks and shovels at the moment. So these are what's happened with large language models is that enterprise clients and big banks, big pharma, government, you name it, have always had this thing: do we build or do we buy? And large language models seems to give the capability to build internally, using your own data, using your own expertise, especially if you're building agentic workflows as well, to kind of cover your own tasks. And to do that, they're going to need a tooling. They're going to need orchestration layers. They're going to need long-tail data. They're going to need evaluation kind of tooling. All of those facts, and we've seen kind of that. And they need things that help them integrate with their own. So we invested in a company called Recurse. we want to basically innovate. We want to bring more code into our platforms at a quicker space because we have these LLMs, but we're frightened about the impact. So we need tooling to do that. So the picks and shovels, the tooling, the orchestration, the data layers, the things that enable people to deploy LLMs in business, I think are very exciting still. I think other things that are really exciting is we're still seeing, and I'm quite like these areas where LLMs don't really play much of a role, such as embedded AI, where the AI comes back, where it's embedded in basic hardware or sensor technology, where it's capturing real-time data and using AI to basically process, classify, predict what that data means. And I think that is really interesting and fascinating because you're affecting, quite frankly, established old industries outside the tech area, and you're bringing in expertise and knowledge to do that. And that's still really interesting. My biggest exit from AIC to date was a company called Odin Vision, who basically is focused on basically computer vision data, classification of computer vision data from endoscopes, the cameras that go down your throat, to detect precancerous polyps. So there's signs of cancer. It's a supervised learning model. You've got to be able to take the data, store it accurately, basically reconstruct it, basically identify to very high levels of sensitivity and specificity. And that company got built last January, so about 18 months ago now, by Olympus. The Japanese, I knew them as camera makers, but actually they make all their money out in medical imaging. And that enables them to have a kind of software AI product to fit in with their hardware and make their hardware products, etc., much more useful, efficacious, etc., etc. So I think that embedded is still there. And the final one I think is really interesting, especially on the day where we learned that Essentius has been built, the AI drug discovery company out of Dundee and Oxford has been bought by an American, basically kind of biotech farm. Is people are using AI to generate de novo, to discover something new, where what they're selling is not the platform, not the software, but actually what they find and what they develop. So the innovation, a drug compound or a new nanotechnology basic material or whatever it is. The AI is effectively a process, but you're not selling the process to others to replicate. You're actually generating something and then taking that and then developing that and selling that. And I think that's an interesting area. And therefore, you're getting into areas where AI companies in areas such as drug discovery are going from being software to full drug companies, like Accenture did, and others like LabGenius is doing at the moment, and others to do that. And that's fascinating.
Having listened to some of your other podcasts, which have all been great appearances, I heard you mention that some of these models have gone disastrously wrong at times. And it's not necessarily just the building of the models that's difficult, but also maintaining them and making sure that they're consistent. Could you elaborate on, you don't have to name any names, on something that, an angel investor today that might not have made an investment, what should they be mindful of in this maintaining of the model?
Well, the other thing is basically you always like the idea and you'll see this in AI companies. They don't they still have to keep on doing R&D. They still have to keep on building, having convinced. You think they've built it. Why have they got even more computer scientists now? Because AI is a probabilistic science. And anything probabilistic basically changes on conditions. Yeah. And so the conditions change. The kind of nature of the data changes a little bit. The kind of, other things, noise, instrument changes, calibrations, you can get completely different results. Right. And so, you're always having this kind of a problem that it's not, I paint the wall, I walk away, I have to come back in 2 years' time. It's a constant battle. It's wild software, as opposed to kind of rules-based, tamed software. And that's the truth. And that's slightly frustrating if you kind of look at them and think, well, can't they just reduce their engineering costs? Kind of like, why they're always there, because it takes so much to maintain it and keep consistency of results.
Makes a lot of sense. In terms of the future for TwinPath, what are your goals and aspirations and targets for that?
Well, obviously, when we say that, maybe one of my LPs will be listening. I want to make my LPs money, serious amounts of money, and I'm fully motivated. We're a smallish funds, and so my own commercial return will come actually only on exits, not on management fees. I want to back some really interesting and impactful businesses because that's what makes me happy and interested and curious and kind of to want to do this job. And and this is a pleasure and basically a privilege. So that's definitely true. And obviously, overall, I want to see AI make the impact I think it can do for the good of the world and society. And I think, maybe you say I've drank in the Kool-Aid, but I do feel it is a foundation technology that could do enormous amounts of good. And I get very frustrated where basically the general public, even my own family, what they know about it is all based on fear and some old Hollywood films.
Yeah. There's several. Elon Musk, isn't he? He's quite outspoken about the dangers of what he thinks could happen with AI, and I think he has now set up a charity to try and prevent it.
Well, OpenAI was supposed to be that for him. That's his own bugbear, isn't it? But I want to say that we get a lot of it is a lot of it's. I'm not going to say that safety is not important and all the rest, etc. It is, but I think sometimes in the media and across the board is that we're not looking at how transformational this can be and what it enables us to do. It will discover drugs we don't know about. It will discover new materials we can't do. It will optimize basic processes, reducing the cost and allowing the whole world to use something that previously was just used by very wealthy people. So all of these kind of things are kind of good. It will drive productivity up if done correctly. All of these kind of things which will create wealth that we can fund the things that people want to fund. I do think that it's the best opportunity and chance that we have to basically in the world to get this growth that we're so wanting. You can basically have the good lives we all want.
I'm with you on that. I'm very optimistic. It definitely needs to happen. And for scaremongers to prevent that change or slow that change down doesn't seem like a rational outcome for all of humanity.
Good, I agree. And definitely not a good outcome for the UK as well. So
no. Where can founders find you? Where should they approach you?
Okay, well, we've obviously got a website called twimpath.vc, which is a little odd. I know we designed it. We may not design like that, but we quite like the fact that it's so yellow. They can contact me directly. I'm very open. CleanPath is free partners. We see everyone. There's no principals or associates between us and the partners that make decisions. So John at twimpath.vc or Nick at twimpath.vc or the amazing Katie at twimpath.vc. It's Katie at twimpath.vc, not amazing Katie, although sometimes I feel that maybe that would be better. And obviously LinkedIn as well, John Spindler. I'm pretty open for LinkedIn requests.
Thank you. This has been a great episode. I really appreciate your time, John. There's so much insights in there for angels and founders. It's been amazing. Thank you.
Thank you so much, Harrison. Have a great day.